This is actually our first episode of just the Industrialist Side of Things podcast, and very special guest with me today. Long time, I just call him my friend. He's my dog. So, J.K. Walker is here with us today. J.K. is the Executive Vice President and Regional President for Third Coast Bank. And J.K., thanks for joining us today.
Glad to be here.
Yeah. So, I just want to kind of start off and, kind of tell everybody how my relationship began with J.K. I when I was 23 years old, I was a musician in a rehearsal studio in an industrial warehouse in Dallas, and the owner of it came to me and said, "Hey man, do you want to buy this?" Because this owner was 65 years old, had no interest in music. Somehow ended up buying this building, or buying this business, and so he's like, "Man, you kind of know real estate, you kind of know music, or I don't know that he was a real critique of my music, but he and so I had the ability to buy this place, and it was a lot of non-credit tenants, and I took it to a lot of banks, and then I actually got the building owner involved and took the building to my brother, but a lot of banks couldn't figure it out, and I had one local bank here that a lot of people use leave me at the altar in the 11th hour, and then so Jeff and my brother had developed a relationship with you, and he said, "Hey, we need to talk to JK about this." And JK figured out how to cross collateralize the loans and make it all work. And
that was a cool introduction to you. And you were a rock star back then, and still today in different industries.
We're still rocking. So
but I mean, that was kind of a cool opportunity. When working with Jeff on that deal, kind of crossing it, using the real estate equity and things like that. And it was kind of an interesting time when we did it.
Yeah. So it was, I think 2004 or 2003, 2004. And so that was kind of our first introduction into, into working together. And, I was managing property and stuff at that time, but as I moved into the commercial real estate side of things, numerous deals, it's so funny. We went to the motor car event the other day that you guys put on.
Oh, yeah.
Awesome event. If you're a client of Third Coast Bank, you get to go drive all the supercars out at Texas Motor Speedway. And I was looking around the room and I was like, "Oh, I know that guy. I'm like, wait a second. I referred all these people over here." Cause anytime a lot of people come in, they're like, "You need a banker." I was like, "Dude, just call this guy."
Yeah, you've been a huge resource.
Yeah.
Yeah. So, a lot of people.
So it's been a great relationship. It's been always where, you're a lot more creative than most bankers I deal with. It's you will always find a solution to something. And the other thing too is when you go to committee with something, it doesn't come back different.
Yeah,
and that's huge. I've had the rug pull happen numerous times from other lenders. And your earnest money is already hard and stuff like that. So you kind of have to live with it. But anyways, so that's kind of the story and the background of JK and I, and probably our top. Third Coast is probably our top lender. But so tell us just a little bit about you, JK. Like where'd you grow up?
Yeah,
where'd you go to school? How'd you get into banking? Why'd you get into banking?
Yeah, well, that's kind of an interesting story. But I grew up here in Dallas and went to high school at St. Mark's and loved football. I know you're a big football guy. And, the teams I played on, we were slow, but we were small. Yeah. And so, we weren't that great. But but I love football. That was one of my favorite things. And, growing up. But went to college, and I was an economics major and thought about being a real estate guy, surprisingly. And I'd already got my real estate license in college.
Okay, where did you go to college?
University of Texas.
Okay, so you're a horn. So
I'm a horn.
Beat the living hell out of us.
I wasn't even going to bring that up.
It's okay.
But
I talk enough shit about Texas. I'll allow it to come back this way.
Yeah. Well, but anyway, so, I was getting out of school in '86 before everybody was born here in the studio.
Yeah.
And
no, I was around. I was 8 years old.
Right. Oh yeah. I guess that's right. So anyway, I just ended up backing into a role in a savings loan production office.
Yeah.
And everything was so bad in this market that everybody was doing SBA loans.
Okay, so was this in the middle of the savings and loan crisis?
Yes,
okay,
right, in the middle of that whole crash in 86. I mean, and then what was happening is the regulatory agencies were coming in trying to put all the Texas banks out of business. Yeah. They came up with a whole new thing, the Texas ratio, to see what percentage of your bad loans represented, what percentage of your capital. And that was a real problem. That's why they call it the Texas ratio.
Yeah.
And so I spent a lot of time, working on basically justifying our love of all these credits. So I'd have to go to different towns and different places to look at the economy and see what was going on and write up reports, try to support the credits. And ultimately, I mean, these were all guaranteed loans that we were talking about back then. Mm-hmm. So they were 100% good, backed by the full faith and credit of the United States. So, ultimately we made it through that. And, ever since then, I mean, the market's been going the right direction for Texas. And, we've seen some slowdowns over the years in my 30-plus year career, but I've always seen opportunities to continue to make deals.
Yeah. So you're at a savings and loan in 86,
yep.
driving all around Texas. Then that kind of all fixes itself. Where's the next stop for JK?
So, my next stop was at a Bank of the West.
Okay.
I went there and I was kind of converting from SBA lending into commercial, regular lending. I went from there to North Dallas Bank, which is another good bank in town.
Yep.
And while I was at North Dallas Bank, got hired by Gateway.
Yep.
And so I started at Gateway, I guess, in 2000, and then we got bought by Prosperity Bank in 07.
Right, because that's when we did our deal. It was Gateway Bank, then
Gateway.
Converted to Prosperity.
And so that was a really good conversion, from a capability standpoint. It was still a big bank, but it was still, we could treat you, like a smaller bank and be nimble and create solutions and things like that.
Yeah.
And, over that period of time, I guess I left Prosperity in 17 and they were, about 30 billion then. It was just different. I was looking for a different opportunity and got hooked up with Third Coast Bank.
Yep.
And they made me North Texas Regional President. And so I've been here for, working on 7 years.
Yeah. And,
thankfully had good relationships like you guys follow me wherever I've gone.
Yeah. Yeah. No, it's, the one thing in banking too, that people, when you have a lender, that you work with, and she's not here, but Renee, your sidekick is phenomenal.
Yes.
And that's, someone, when you're looking for a lender, it's always good to know who that person is too, because you spend a lot of time with that relationship as well. And
I mean, I couldn't do any of the stuff I do without Renee.
Yeah.
I mean, she is a control person who understands all the details, where all the problems are hidden. She brings them out front, early on. And so, just this week we had a closing and we had a switch and dollar amount and all this other stuff. We were doing a swap. Mm-hmm. And I mean, we were able to get that turned around in 24 hours.
Yeah.
Which is just unheard of.
Yeah.
Really. So,
no, she's
great.
She's awesome, man. She's awesome. Well, I want to get into kind of just the functions of a bank. I think there's, the audience for this is a lot of commercial real estate guys, probably a lot of brokers, because that's my kind of pool of cadre, and so let's just talk about the basic functions of the bank. A bank, when someone tells me a bank is a $10 billion bank or a $20 billion bank, what does that really mean? Is that your deposits? Is that your revenue?
Yeah, it's total assets. So basically, you have in banking, things are kind of backwards. So deposits are liabilities.
Yeah.
Loans are assets, although the risk is really on the loan side.
Yeah.
But your total assets are going to be fixed assets, loans, other investments, things like that. And then on the liability side, you got deposits, and you add that to your capital, you get your total assets.
Okay, so other investments, what other than a loan, what are other investments that banks make?
So it depends on the type of bank and where they are in terms of loan to deposit ratio.
Okay.
So banks that are really low loan to deposit ratio have historically invested in treasuries and things like that, which we've seen recently doesn't always work out the best way. You've got loans, you've got other kinds of investments, guarantees, things like that. There's a lot of different things you could invest in. But, for the vast majority of us, we're all making loans.
Yeah.
And so, a bank like Third Coast, we didn't have any exposure to, securities and things like that, no long-term dated stuff. You have a lot of banks that are in the mortgage business, and some of those that portfolio those loans had some risk on those because they were really low priced.
Yeah. So, okay. So a bank is total assets, and they can grow their assets by growing deposits, because essentially you're taking the deposits from a depositor and lending that money out and making
going
spread.
into some kind of investment.
Going into spread. Okay. So now there has to be some kind of ratio, right? Like, if you have $5 billion on deposit, then what can you make in loans off of that?
It depends on your capital.
Okay.
Right? So your capital dictates kind of what your leverage can be.
Okay.
And so the higher your capital,
your capital being your deposits, or
it's your equity.
Your equity.
Yeah.
Okay.
Yeah. So your equity in the assets. So all the ratios on loans are based on your capital capabilities and your concentrations and things like that. So now you're seeing, concentration risk on construction, certain real estate types, things like that are a percentage of your capital.
Okay. So your equity comes from, we're in this loan at 50 cents on the dollar on the value of this asset. Is that?
It's based on retained earnings and paid in capital.
Okay.
Yeah.
Okay.
So it's all based on earnings.
Okay. So, and what's like a rule of thumb? Is there a rule of thumb ratio that I can say, okay, well, if we've got this much in equity, we can loan out this much? Is there?
Yeah. I mean, and it's a risk factor. So, you look at a bank like ours, and I can't give you the exact calculation, but, our bank is about $4.2 billion. Our legal lending limit is over $100 million, but our internal guidelines are $25 million per borrower.
Okay.
So we don't have any huge concentration in any one credit.
So your legal lending limit per your agreement, your regulatory agreement with the federal government is $100 million. Is that? And
yeah, based on our capital.
So you could give me $100 million if you want to, but y'all choose to only go out to $25 million
at the current time. Now, when we first started working together,
we were 15 or something, or
lower. I mean, we probably started at 5.
Yeah.
And then we've grown over the years, and so now, we're probably going to continue as we've grown, to take that up. So we're probably going to go into the $30 to $50 million range.
Yeah.
In the near future, probably.
So, okay. So your depositors, you're lending out that money. Now you're paying interest on your deposits.
On some of it. Yeah. And you look at your cost of funds.
Yeah. So does it, a lot of banks made a lot of loans over the past couple of years in the low interest rates, 3s. I mean, I know I got some high 3s, low 4s with you on stuff that we did years ago that, does the bank are they still making money on a loan like that? Or is that actually a negative?
Yeah, it can be a negative.
Yeah.
I mean, it definitely impacts earnings. So, what happens is your margin gets squeezed. Okay. So if you've got a loan at, 3.5 or 4.5 in cost of funds 2 years ago were, less than 2%, right?
Yeah.
So you had some margin in there. I say typically you're going to want to have 3% margin.
Yeah.
In your cost of funds. Above your cost of funds is kind of the safety range, depending on your capital position. But
and is cost of funds the overnight banking rate essentially? Is that? Or is that?
It's actually what you're paying your depositors.
Okay.
So on operating accounts and things like that, you're going to have non-interest bearing accounts for a large portion of that. So the more of those type of operating account relationships you can get, the more efficient you're going to be in terms of your cost of funds.
Okay.
The other sources are going to be CDs, money market accounts, where everybody's competing, based on price.
And you got a fixed cost in that one because you're, like you said, you're competing out in the market, so you're offering a product at a price.
Yeah, so sometimes you're going to pay more than other people would pay because you're wanting to fill a gap in your funding capabilities.
So if you're putting out a CD at 5.5%, you're hoping to lend money out at 8.5%. Essentially,
that's pretty much right.
Okay.
Yeah.
All right. So 300-point spread, but like operating businesses that have large deposits, operating reserves, and stuff like that, those are great because you're making full spread on that money, essentially.
Well, theoretically.
Yeah.
I mean, you have some cost of overhead, but, you just think about your efficiency in the banking world, all the services, the locations you have, all the different things that cost you money. You got to make it all on that.
Yeah. So is there a reason banks, is it a regulatory thing? Can banks not take equity positions into things? Is that a?
Yeah, and the savings and loans used to do that, and of course it all blew up over on I-20.
Okay.
Yeah.
All right.
You remember that?
Okay. Okay.
Yeah. So banks don't do that.
Yeah, because I always thought about starting a bank called I Take Bets. And
yeah, that'd be easy to get done.
Right. Okay. All right. So, so banks go out so well, let's talk about Silicon Valley Bank for a minute. So just everybody kind of understands what kind of happened there. They ramped up very big. They were the 16th largest bank, at the time. And essentially over COVID, everybody got all this money and started putting all this money in these accounts.
Not necessarily.
No? Okay.
No, Silicon Valley Bank really focused on venture capital.
Yeah.
And it was all based on one industry type and one customer type.
Yeah.
And so the lack of diversity and diversification in their portfolio, when that market went down, whacked them. And they also had a ton of treasuries.
Okay. Going back to the treasuries though, COVID kind of led to deposits going up. Did y'all see that as a bank? Because everybody's making PPP loans and money is just flowing into people's accounts.
You're right about that.
So Silicon Valley Bank's deposits increased, so they had to go invest that money. So they went out and bought bonds, which they thought would be a safe investment.
Right.
And then the bond market flipped on its head when interest rates went up.
They paid no attention to interest rate risk.
Yeah, and so they, when that happened, they got marked down on their investment. Yeah. $20 billion or $17 billion, something like that. So when they reported that, people got pretty scared, and then the venture capital guys kind of made a run on the bank, essentially.
Well, and the other thing is they had, of all the banks in America, they were at the very top of most uninsured deposits. So anything over $250 per tax ID number is uninsured unless you're in some kind of special program.
Well, that's actually incorrect, JK, because the federal government insured everything.
Yeah, they did. Actually, they had a report out today that banks under $5 billion aren't going to have to help make up the difference on that.
Oh, so it was only the banks that were going to have to chip in,
banks
not the taxpayer?
Chip it all in. Yeah.
Okay. So it's funny how we make rules and just don't follow them. So are they really rules?
That's happened a couple times though, right?
Yeah.
So the last time we had the big crisis.
Yeah. And nobody went to jail. I think one guy went to jail for 30 days. That was it.
Yeah.
So, okay. Well, so the interesting thing about those banks going down was the regulation that was put in place during the 08-09 crash of Dodd-Frank, right?
Yeah.
Named after Barney Frank, who was literally on the board of Signature Bank when it collapsed.
Yeah.
So kind of ironic. But I guess Trump, people blame Trump for easing up the regulations again on it, saying this is why it happened. But, isn't everybody a business owner at some point?
Yeah,
and they have to own it.
Yeah, part of it is, the board of the banks that weren't paying attention to that risk are at fault. The regulatory guys who are there every day at a bank that size weren't, bringing that to their attention. Nobody was paying attention to the risk.
Yeah.
So that doesn't make sense. Those are, some disconnects out there that just, we'll never know.
Well, and so I would say that at that time, a lot of people thought regional banks were just going to start collapsing. And this is March.
Yeah.
Right?
There were some big runs on some banks.
And so was that just customer fear driven, you think, or was there a lot of regional? It didn't sound like you guys were not exposed to a lot of.
No. And again, there's a lot of banks like us that are, well diversified. But the first thing we did was call our customers and say, here's your risk. Here's solutions.
Yeah.
If you want a larger insured type product, we can do that. And we actually picked up deposits during that period of time, which was interesting.
Yeah, that was like Monday morning, right?
Yeah.
You know what I did that Monday morning? I called the bank that I had a loan out with that they had sent me an interest rate lock on Friday tied to treasuries. To the 5-year, and the 5-year dropped 80 basis points, and then I tried to sign my new thing, and they wouldn't honor it.
Yeah.
It was we forgot to put a floor in there. So
got to read the details.
Yeah, right. So okay, so what kind of products are out there now? Though we kind of had a conversation about this. You said there's kind of some more interesting products coming out, like. I don't want to call it a credit default swap, but something similar. Anyways.
Yeah, I know some of the bigger banks have, and there's a market out there for everything now.
Mm-hmm.
You got tax credits, you've got all kinds of different things in the market now that people are going after.
Mm-hmm.
And it seems like, there's a new product to help, banks lay off a lot of their risk. And those are going into pools. And that's not something I've gotten, well educated on, just, keeping up with that Wall Street Journal and things like that. But yeah, I mean, what you're seeing in the world right now is technology. And one of the things that's changed in my career over the last 2 years is now I'm also managing director of innovation at the bank.
Yeah,
and so
I saw that on your profile, and I was like, I don't know what that means.
Yeah, I've been paying attention the last 2 years and kind of drinking out of a fire hose. What's going on in fintech?
Yeah.
We kind of investigated to see what was going on with cryptocurrencies. Just kind of seeing what's going on in those markets. And I mean, there's a lot of opportunity out there in the banking world right now for banks that are, up to date, cutting edge on what's going on with technology and banking. And you've got, artificial intelligence, AI, is everybody's talking about that now.
Yeah.
You got ChatGPT, you got all this other stuff, and people trying to figure out ways to use that safely. And then, when it's in the banking world, it's all got to be covered from a regulatory standpoint, compliance, risk, all that sort of thing. And so it's really interesting to see what's going on right now. And, banks that are kind of sticking their neck out, trying some things that haven't really been blessed by the regulators are getting,
in their hands slapped,
some stern letters.
Yeah. So what do you see? We've started using ChatGPT. Isabella's kind of our resident expert on that stuff, but we've prompted it to abstract leases on properties we're buying. We'd say, look for these 15 data points in the lease and abstract it. And we still go back and read it ourselves because we just don't trust it yet. Yeah. But what do you see AI in banking be able to do?
Well, I mean, from a banking perspective, and this stuff's been going on for a while, trying to identify trends with your customers, what they're doing, where they spend their money. What we found out is, a typical customer, a commercial customer, is going to have maybe 17 or more financial providers in one form or fashion.
Mm-hmm.
So, you may have multiple banks, you got multiple credit cards, you got different services that you're using. You may have, management tools and things like that. They're also a financial, capability.
Mm-hmm.
And so, you can use AI to really investigate what's going on with your customers and uncover opportunities, maybe help consolidate some things, maybe help, correct some things that may not be working correctly.
Yeah.
And then just opportunities that you hadn't seen before.
Right. Well, okay. So now banks are obviously scrutinizing their portfolios, especially their loan portfolios, and probably more focused on the concentrations in commercial real estate assets.
That's a big piece of it. The vast majority of loans that Texas banks make have been real estate.
Yeah.
I mean, our ratio, we're probably a little better than most in terms of C&I and what we do and with our corporate banking. But a lot of banks are, probably 80% real estate.
Yeah.
And you've got a lot of different, types of real estate that you could be in.
Right.
But so right now what we're seeing and where the risk is and the discomfort for some people is looking at, okay, the maturities you have coming up that you may have renewals on deals that were priced at 3.5 that are now going to be at 8.5 or 8 or whatever.
Right.
And so what's that delta look like in relation to, what's going on in the economy, the tenants that they have, repayment ability and things like that.
Yeah. So the cash in refi is a
new thing.
Yeah.
So, I don't have a line of people wanting to do that though.
Yeah.
No.
Yeah. That's what
I love that terminology. I think I'm going to steal that.
Yeah. So you have, you kind of made me do this exercise. We took our whole portfolio and mark-to-marketed all of our loans at 10%.
Yeah.
And, thankfully, I think we probably only had out of 27 loans or something like that, we probably had a 5 that wouldn't be hitting debt service coverage at that time. So,
which is really good.
Yeah. No, I felt really good about that. I felt showed that we added the value we thought we would add to an asset. And when we took it on. So as you look at these pool of loans, do y'all segregate asset classes at all? Like, is it like, do you punish industrial because you have office loans? Does that make, you see what I'm saying?
I see what you're saying, but I think I think a lot of things fall in the same category.
Yeah.
So industrial is going to fall in there. Office is going to fall in there. Multifamily is going to fall in there. And so what really ends up happening is, where are your concentrations? So if you're a heavy office lender right now, probably a lot of scrutiny.
Yeah.
On the industrial side, which I've always focused on that. For my whole career, that's still a strong market. Maybe there's some slowdowns here and there, and maybe some hiccups in demand. You know that better than me. But, I don't think we really have an issue with it based on performance.
Yeah.
So as long as the performance is good, you can go through your exams and go through all that process of looking at your asset quality. And what we've seen, and we have third parties come look at it besides our regulatory bodies, we're in really good shape there. So we're real pleased with that right now. So,
when you look at your current borrowers and you see maybe someone that's, they got a freight train coming their way on a refi, like how far out ahead are y'all trying to think about that, with your client and, hey man, like
12 months in advance,
12 months, like, because
I'm really looking into, 25, 26, trying to see what we have, just to see if there's anything out there.
Yeah.
And our board looks at it that way too.
So. Yeah. That's one thing we're, I need to show you too, like our sales force we talked about and all that stuff. And we're tagging debt maturities.
Yeah.
And, we've done our deals we're going to only have done 6 or 7 deals this year. And I think 3 of them are going to be owner financed, and, the one will close at the beginning of next year will be owner finance. So that's, that's where we're having to shift, especially because we're a lot of value add and, y'all's banks' appetites for any kind of spec, anything is, I don't think there is an appetite for it. Is there?
Yeah, I think it's tight right now. I think everybody's trying to see where the market settles, where rates are going to go. I think, most people are thinking we're probably done with rate increases.
Yeah.
And we'll see over the next, 12 to 24, 36 months, kind of where things end up.
Yeah. Do you think they start pulling rates back next year? I don't. That's my opinion.
Yeah. I don't really see it until, I think we get a change in mentality.
Yeah.
In leadership.
Yeah.
So we'll see.
So
I don't really see any pullbacks.
Yeah.
But who knows?
I agree. Okay, so I guess overall, though, Dallas-Fort Worth seems to be pretty strong. Now, though, I will say it seems like the office market is, those are tombstones that have Corona written on the top of them.
Well, I think, and this too. We've had so many people moving here. So, there's a metric for population and the right level of industrial, retail, multifamily, office, all this stuff. Now, maybe the office market metrics are changing.
Yeah.
Right. Just because we have a new mentality of how we work.
Yeah.
But the industrial side, people still have to go into the shop to build whatever they're building.
Right.
Distribute whatever they're, processing. So, I think that is kind of a different, demand stability compared to office.
Well, when we all started in industrial, it was not sexy.
Yeah. For 25 years, everything was trading between $25 and $35 a foot.
Yeah.
And rental rates were $250 to $450 maybe.
I told someone the other day, I said, the operating expenses on this property are what I used to lease buildings for on a gross basis.
Yeah.
It's insane. Like,
I was thinking about this. It's like over the last, you call it 3 years?
Mm-hmm.
Even 2 years.
Yeah.
We watched it go up, 300%.
Oh yeah. Easily. It, I was just looking at a lease renewal for a client of mine and, he's on a base year of 2016 with 86 cents a foot in OpEx.
Yeah.
And the new OpEx is 171 a foot, for 2022. And, going in to negotiate that lease renewal for him, I was like, we need to move his base year up, because I'm repping him as the tenant rep. And so, well, let's talk about like what you guys look for in a, in a borrower. Like, is it, you ever heard the jockey or the horse theory? Like, are you betting on the jockey or are you betting on the horse or, a little combination of both? So
I think, I think different banks look at things different ways. Big banks go after a different market segment, a different client type, things like that. The community banking side, it's about relationships.
Yeah.
People that you know, people that you can trust, people with good character, good credit, things like that. I mean, there's some basics you got to have to get started.
Yeah.
But, once you build your reputation inside that bank, it carries you a long way. And then, you get more and more liberty in terms of, having confidence in you to be able to do this, X, Y, and Z.
Yeah.
Versus somebody that is coming in brand new.
Right. Yeah. I got you. So it starts with a little bit of the jockey and more of the horse, and then probably shifts more of the jockey and less of the horse to a degree, or the jockey's track record on that horse.
Yeah, exactly.
So
as long as he's riding the same quality horse all the time.
There you go. So I'm a new borrower. I'm trying to get in to buy some investment commercial real estate. I come to you for a loan. Like, what kind of liquidity are you looking for in me as a borrower to, just kind of baseline, Is it a function of loan amount to liquid on the borrower side?
Yeah, and it depends again on type, and if it's an income producing deal, and if it's stabilized, and all those sort of things. If you're going into a deal that's speculative, I mean, you really need to have some deep pockets to be able to carry that stuff, because you just don't know what kind of market swings you're going to run into. And so, it's equity intensive. You got to have the right kind of equity in the deal, and you got to have, the staying power.
Yeah. So like, let's say I'm coming to you for $1 million loan. Do you want to see at least $1 million, or maybe, 100,000, 10% of loan amount, 15% of loan amount, and liquidity? Like,
yeah, I mean, I'd like to see, this is just me personally, but, I'd like to see somebody with, some good reserves in terms of, retirement savings, good equity in their homes, not crazy personal leverage, things like that.
Yeah.
But I mean, if you have like 25% of the asset value, I think that kind of
solves it
better.
Yeah. Gotcha. Okay. And then what do banks like to price off of? I mean, you have a couple different products within your commercial lending stuff, but like, what is the pricing strategy, and why does that even matter? So typically banks will price off either SOFR, Treasury, Prime, but why does that matter if you're really just spreading on deposits?
Yeah, it doesn't matter if you're using SOFR or Prime or whatever. Yeah. It's the margin.
It's the margin, right?
Yeah. So you need to keep a certain margin over whatever your cost of funds are.
Okay. But your cost of funds are kind of an internal calculation on your bank, right? So SOFR and Treasuries, are these just a benchmark for people?
They're just a benchmark because you're getting a margin over it.
Yeah. So maybe.
And SOFR and used to have LIBOR and all that. A lot of people price that way because it'd be, a national shared credit, things like that, where people are pricing that way.
Yeah.
More international, view on pricing.
Right.
The independent community banks are looking at Prime because that's our cost of funds. Fed funds is going to be 3% less than Prime, basically.
Okay. Yeah, because they're sitting at 5.5 right now, right? So now you call Fed funds your cost of funds, but your real cost of funds
depends on where you get your money, though.
Okay.
Yeah. So
can you go borrow money from the Fed at 5.5?
Yeah.
Okay.
Yeah.
But you have to be a bank to do that.
Yes.
Okay.
Yeah.
And you can't lend to yourself, right?
No. No, but I mean, your whole cost of funds is part of your, carrying cost. It's your cost of goods.
Yeah.
Gotcha. And so, that margin's going to change. If you're needing funding, you may be, paying a little bit more on interest on your accounts.
Yeah.
And so your margin may get squeezed a little bit. And so that impacts, what you can really price your loans at on a profitable basis. The other thing is, and you brought this point up earlier, you've got a lagging indicator, following you as rates change, right? So you've got, loans priced in the 3s, 4s, and 5s. That are maturing, and you're going to reprice to better pricing as things happen. Mm-hmm. But for that period of time, you may have loans that are earning less than Fed funds.
Yeah.
So I mean, you'd be better off just giving your money to the Fed than having those loans.
Yeah,
if that makes sense.
Yeah. So all you borrowers out there with those low loans, please sell your building and give them their money back.
Yes, please. Yes.
Okay. So overall, though, what do you see in the Dallas market?
So I think the population increase. Mm-hmm. I think I think we're in the best place in the country right now.
Yeah.
So I think, we're going to be less impacted than other areas. I think, some of the really, really bad news you're hearing, even that we've addressed, talked about office some, but I mean, across the country, the places that are really having trouble are so much worse than Dallas, right? I mean, you got issues where people are leaving, you got population, exodus, and it's coming here.
Yeah.
So you got taxpayers, you got grocery buyers, you got, energy users, you got all these different things that help promote, jobs and demand for certain things, right?
Yeah.
So I think, the comfort that we have right now, in this current inflationary environment and the pricing of rates and everything, it's not as comfortable.
Yeah.
But I still think we're very blessed to be where we are.
Right. And Third Coast Bank, they're based out of Houston, headquartered out of Houston.
Humble, Texas. Yeah.
Humble. And where all do they service besides Texas? Any other states? Or?
We do serve other states, but all of our locations are within the state of Texas. And we basically have the big,
Mm-hmm.
corporate triangle, Dallas, Austin, San Antonio, Houston, back up to Dallas.
Right.
And then we have some small town stuff. But on our corporate lending, we do serve, some national credits and are in that world. On the specialty lending, we've worked with a lot of the big home builders.
Yeah.
And so there's some presence outside of the state of Texas for that.
Yeah.
But the vast majority of what I do in the community lending is, local.
Local. Yeah. And we've done deals in San Antonio area too.
The state of Texas is local.
Yeah. Will is convincing me and pushing me over the edge to go to Houston. So
yeah.
I don't know. We might start looking down in Houston. I don't know. We'll see. I'm still on the fence on that.
Yeah.
So just from a standpoint of, I just don't like driving around Houston, although Dallas is pretty much turning into Houston.
Yeah. I think the tollways make Dallas so easy.
It does.
Really.
Yeah.
I mean, getting around here is easy. I was out, on the west side of Fort Worth yesterday and just had to drive out there and back. And it's like, it doesn't take long to get on a tollway here, and it makes it pretty easy.
It is kind of 30 minutes anywhere in Dallas. And that's we did execute very well on that. Now 635 is a total nightmare right now.
Yeah, I got a little of that, and that's not any fun.
Well, man, I appreciate you coming on today.
Yeah, I appreciate you having me on.
Really good information. I think hopefully that helps some people kind of really understand what banking really works like. If anybody needs a loan and, user of space, business, I used to have multiple businesses and I always had my deposits with you but looking for just a phenomenal relationship. JK's the guy for that. So, okay. So one thing we have a commonality and we like to discuss is college football.
Yes.
And we've got a big championship weekend coming up this weekend. And just want to get your perspective on a little line action here for the commercial real estate gambling degenerates out there.
I was wondering how much you were in the hole right now, or if you're good.
Yeah, I told Turner the other day, I was like, hey man, I think we're gonna do you bet on anything after football? Because he goes, no, not really. I was like, damn it, because I was gonna have you be like the call-in guy. I was like, well, we'll get it for bowl season. So, all right, so you got SMU and Tulane in the Atlantic Conference Championship. It's kind of a home game for Tulane.
Yeah.
SMU's getting 4.
I like the Ponies.
I like the Ponies too.
And I think they look better.
Here's my reasoning. Tulane barely beat Rice. Rice is actually bowl eligible this year. Rice actually had a pretty good team this year. Good. Tulane struggled with Rice, and SMU beat the hell out of them.
Yeah.
So there's my, degree of separation there.
Yeah, UT San Antonio, they played them too and didn't look that great.
Yeah. Let's go to your team, the Longhorns.
The Longhorns, yes.
The Longhorns are given 14 against Oklahoma State.
I've been wanting them to have the kind of dominant performance they had last week against the team not to be named.
Bring it in. Oh.
But I mean, I don't know. I kind of believe they can play that well every week. So we'll see what they bring.
I think they beat the hell out of Oklahoma State. I think the one thing Texas finally did against Tech was figure out how to play 4 quarters.
Yeah, they did.
The first half of the year, they they'd win the game in the first half and put it on cruise control and let everybody get within striking distance. But, man, they never took the foot off our throat.
But the great thing, what they did last week was they did it with their second teamers because they had a lot of injuries and people come at it. I mean, they just kept on coming. So,
how about Arch Manning?
Man, I'm excited about him.
You know, I remember watching his high school film and I was like,
not that big a deal.
But, man, I thought he looked really good the other day.
He really did. He's got wheels, and, man, he's got a super arm.
His arm was like a rocket.
Yeah. I was like, whoa.
Yeah, so I'm taking Texas to beat the hell out of Oklahoma State. And Oklahoma State they're not consistent. Yeah. I mean, they
didn't look that good against BYU.
They didn't look good against BYU. They lost to UCF. I mean, they got destroyed by UCF. Yeah. It was 45-3.
Yeah. Texas has always had trouble with them for some reason with Gundy, but But I think they're ready.
You know, I'm kind of shocked Gundy's never been fired.
Yeah, is he like the longest tenured coach out there?
I mean, yeah, but I mean, look how much talent he's put in the NFL and never won it. I don't know. I don't know. I don't think they'll ever get rid of him, but I could see a case for it. Speaking of coaches, A&M, that's always a fun topic for people like you and I to talk about.
Yeah,
right?
Did you see the new contract?
What did he get? He got
it's really incentive based. So
he's
like getting $7 million a year, which is not a bad starting paycheck for most.
But he gets playoff checks.
Yep, and like a $3.5 million bonus if he wins it all. But yeah, wasn't he just out of the same fold?
Yeah, he what was it? They passed on Bob Stoops, who was a defensive coordinator for Jimbo Fisher, and had a 16-7 record to hire another defensive coordinator for Jimbo Fisher who was 16-7. Some stupid stat like that.
Yeah, my son's an Aggie. He's not that excited about it.
Yeah, I don't know. I don't know what they do there.
Yeah. Hey, he may do great, but
he may do great. I don't know. I feel like A&M. I feel like A&M always feels like they're somewhere they should have been that they're really not. You know, it's been since 1939.
Yeah.
So, but anyways, so Georgia and Alabama. This will be an interesting game for you to watch because after y'all thoroughly stomp Oklahoma State, this has a lot of.
It could. So which way do you think it has to go? Because I mean, I've kind of resigned myself to Big 12 championship, and that's going to be the best we can do.
I mean, I think you got to have Georgia beat Alabama.
Yeah.
I mean, that has to happen. I think if Alabama beats Georgia, then Alabama is in, and I think Georgia gets in just because they're Georgia in 1 point. So Bama's getting 5. I think Georgia wins, but I think Bama covers.
I could see Bama winning.
Yeah, it could happen. It could happen.
They've been playing well.
They have been.
And they're making some miracles happen.
Yeah, they are.
That throw last week.
That was unbelievable.
Corner,
yeah.
It's perfect. And it's just like, how did that happen?
You know what's funny is when Odell Beckham Jr. made that catch on Monday Night Football or whatever it was so many years ago against the Cowboys, it was like no one had ever seen anything like that. Yeah. Now that's like a normal thing.
It is.
Catching a ball like that's like, oh, look, another one-handed catch.
Yeah, it's crazy.
And then you got kids in high school just doing it all the time now. Yeah. I don't know what it is. Maybe we throw more or the gloves. The gloves are better.
It's got to be the gloves.
They're totally different.
Yeah.
All right, last game I got Louisville versus Florida State.
We need Louisville, right?
Yeah,
or I do.
You need Louisville to win. You got a chance. Louisville's playing pretty good.
They are.
Florida State doesn't have their quarterback.
Yeah.
Florida State
didn't really hurt them too bad last week, though.
No,
they hung in there because of defense stuff.
Well, I mean, but Florida's a garbage team.
Really?
I mean, they didn't even go to a bowl. They're not even going to a bowl.
Yeah. I mean,
could you imagine the Florida Gators don't even go to a bowl? My in-laws they're having a hard time right now. But it was 12. Florida was up 12-0 going into halftime, I think, and then Florida State got it together.
Yeah.
Took them out. But Florida State's given 3 points. Louisville's getting 3. I don't know. I mean, I could see Louisville getting up to win this game and win it. And Florida State's dream season is kind of, know.
I think you go with them just because the advantage on the quarterback absence.
Yeah. So, all right. Well, we will sync up next week and see how we did. So.
Sounds good. All right.
All right.
Good luck.
Yeah.